Okay, in this lesson, we'll discuss futures contracts, including how they are similar to forwards and some of the unique characteristics that they have, such as margin accounts and marking to market. The futures are very similar to forwards, and they're priced in much the same way. Essentially, futures are standardized versions of forward contracts that are traded on an exchange. Where forwards are one-off agreements between two parties, futures are traded much like stocks, bonds, and other standard securities. A clearinghouse matches buyers and sellers and acts as a counterparty to all future contracts. The clearinghouse ensures that the market remains liquid and active, and it serves as the record keeper for each party's obligations. The liquidity of the futures marketplace makes it easier for parties to offset existing positions, facilitating risk management. One key feature of futures contracts is that they are typically settled in cash on a daily basis through what's known as a mark-to-market process. This daily settlement ensures that the party on the losing end of the futures contract provides funding up to specified levels every day, thus ensuring very low credit risk. This funding occurs through margin accounts, which we'll talk about next. In order to ensure the liquid, low credit risk market necessary for standardized futures contracts, buyers and sellers are required to deposit funds with the clearinghouse or broker to cover potential losses. This is a form of collateral, but it's collateral that is actually involved in the transaction rather than sort of off to the side and only called upon in case of default. Here's how it works. The broker, as the counterparty to all futures contracts, is ultimately liable to pay if one party defaults. So the broker specifies the amount of margin required, say 10% or 20% of the value of the contracts, in order to feel comfortable that the broker's risk is minimized. The broker might use such factors as the volatility of the underlying security or the creditworthiness of the parties in order to set the margin size. And since the broker is holding these funds and the parties can't access them, the broker will credit interest on the margin balances. In addition to the initial margin, the broker sets a minimum level to which the margin account is permitted to decline before some action is taken. This level is known as the maintenance margin, and it's typically 70% or 80% of the initial margin account. If the margin falls to the maintenance margin level, the broker will require the party to add more funds to the margin account. This is known as a margin call. For a futures contract, the return is often expressed as a percentage of the initial margin, since the initial margin is the amount of cash that a party is required to commit up front. Remember that similar to a forward contract, there is otherwise no cash flow when you enter into a futures contract. So let's look at an example. This example will help to explain the mark-to-market process, and then we'll look at another example that incorporates margins. So here's our setup. Party A buys 10,000 180-day futures contracts from Party B, with each contract representing a single share of stock. The parties will mark the contracts to market daily, and cash will change hands based on the change in market value of the contracts. Remember that for futures, just as for forwards, no cash changes hands at the time of the purchase. The current stock price is $40, and the continuous dividend rate is 4%. We specify that the futures price is the same as the forward price, which is typically going to be the case. Our risk-free interest rate is 10% compounded continuously. After one day, the stock price increases to $42. This should tell you that the futures contracts have become more valuable since the stock just became more valuable. We're looking for the mark-to-market payment that Party B, the seller of the contracts, must make to Party A, the purchaser of the contracts, on this overnight change in the stock price. So first, we need to determine the price of the futures contract at the time of purchase. The setup specified that the futures price is the same as the forward price, so we're free to use our forward pricing formula. The forward price is the current stock price increased at the risk-free interest rate and decreased by the dividend rate for the 180-day term of the contract. Recall that Party A purchased 10,000 of these contracts, so we need to multiply our forward price for a single share of stock by 10,000. The resulting forward price, and thus futures price, is 10,000 times the current stock price of 40 times e raised to the r minus delta, or 0.1 minus 0.04, times 180 over 365. This gives us a total price of $412,012. After one day, we mark the contracts to market by repricing them. This is the same calculation as above, except that we replace yesterday's stock price of 40 with today's price of 42, and we also have one fewer day in our term. So the time term in the exponential function is now 179 over 365 rather than 180 over 365. So our current price calculates to $432,542. Thus, the contracts are indeed more valuable today, and this is settled by Party B paying Party A the difference between today's price and yesterday's price, or $20,530. This mark-to-market cash settlement would occur on each of the 180 days of the term unless the contracts are canceled by mutual agreement. Now let's look at another example from the book, this one involving margin accounts. Our setup involves S&P 500 futures contracts. So one nuance here to note is that S&P 500 futures, which are of course a real thing, are typically traded with a notional value of $250 times the value of the index. As of the time of this lecture, the S&P 500 index is hovering around 3,000. Let's hope that it's much higher by the time you view the video. This means that a current S&P 500 futures contract would be worth $250 times 3,000, or $750,000. But since you can't really buy the S&P 500 index per se, these contracts are almost always settled in cash. For our example here, the S&P 500 index is assumed to be at 1,100 today. We have an investor who buys 8 contracts and is required to post an initial margin of 10%, with the margin account credited with interest at a rate of 6%. We're looking for the balance in the margin account if the index value drops to 1027.99 after 1 week, and we're assuming cash settlement occurs on a weekly basis. First, we determine the value of the position at the time of purchase, so that we know how much is required to be deposited into the margin account. Again, no cash changes hands at the time of the purchase, but the buyer is required to deposit that 10% into the margin account to protect the seller. The buyer purchased 8 contracts at a notional value of $250 times the 1,100 index value, for a total notional value of $2.2 million. At a 10% margin rate, this means that the buyer must deposit $220,000 into the margin account, which begins earning interest at 6% immediately. After 1 week, the margin account has earned some interest. We can calculate using our 6% continuous rate, and we find that just under $254 in interest was earned. Now we need to account for the change in the index value, which in this case was a drop in the value from 1,100 to 1027.99, which is about 6.5%. This drop in the index value changes the notional value of the contracts by about $72 times 8 times 250, or about $144,000 in total. This loss in value can either be paid directly from the buyer to the seller, or it can be taken out of the margin account. If the loss is taken from the margin account, our margin value drops all the way down to $76,233.99. So a 6.5% drop in the index results in a 65% drop in the margin account. It's very likely that this kind of drop in margin value would trigger a margin call, requiring the buyer to make an additional deposit into the margin account to protect against future losses. Table 5.8 in the book illustrates what happens to this margin account if we allow this example to play out for 10 weeks, with the index value changing week to week. You should review this example to ensure that you understand how margins operate. The multiplier here is just the 8 contracts times the 250 notional value per index point. That's the 2,000 you see in the multiplier column. After week 10 in this example, the margin account sits at about $45,000. The total loss after 10 weeks is determined by subtracting the future value of the initial margin deposit from the final margin balance. We use the future value of the initial margin deposit because we could have taken that $220,000 that we deposited into the margin account and earned the 6% risk-free rate of interest on it. So it's an opportunity cost that adds to our loss. The loss then is calculated to be $177,562.60. Finally, let's look at the differences in prices between futures and forwards. As in our example, they are generally very similar. The biggest difference comes from the crediting of interest on margin accounts for futures contracts, which doesn't happen for forwards. The differences depend on the correlation between the interest rate credited and the price of the underlying security. If they're positively correlated, then an increase in the security price, and thus in the futures contract, coincides with an increased rate of interest, so there's a double benefit to the buyer. This leads to the futures price exceeding the forward price as the futures contract becomes more valuable relative to the forward contract. If the correlation is negative, then the opposite occurs, and the futures contract is less valuable than a forward that pays no interest. Of course, since interest becomes a more significant component as the contract length increases, the price differences also increase with contract length. Short-term contracts show very little difference in price between futures and forwards, while the difference can be quite material for long-term contracts.